How to benefit from penny stocks. You may have heard of penny stocks. It comes with high risks but also has the potential for above-average returns. Know more about penny stocks and discover how you can benefit from it. Only a few full-service brokerages offer penny stocks to their clients. Penny stocks come in the form of shares in companies headed for bankruptcy, with small or new companies with little or no following, and businesses that are deep in debt. It may sound like a risky endeavor, but you can make money with penny stocks. Before we go deep into it, first learn what penny stocks are. Simply put, penny stocks are shares that trade for less than $1. The Securities and Exchange Commission, or SEC, defines them as stocks trading for less than $5. Penny stocks are usually traded on so-called pink sheets, or the OTC Bulletin Board (OTCBB). Approach both with caution. Companies trading on pink sheets are not required to file with the SEC, unlike OTCBB stocks. OTCBB trading also has its risks. It is difficult to find enough solid information to form a logical conclusion on the financial health or stability of the company. Remember, there are no minimum standards for a company to remain on the pink sheets or the OTCBB. Next, you should be aware that there are a lot of penny stock scams that make money by luring inexperienced investors into investing in worthless companies. To help you, here is a list of common penny stock scams that you should avoid. Pump and dump schemes happen frequently. Scammers promote interest in a little-known or unknown company. They lure inexperienced investors to buy the shares, thereby lifting the price. Once the stock price reaches a certain inflated level, the scammers will sell, or dump the stock, earning for themselves a large profit while leaving investors with nothing. Pump and dump schemes are often advertised through free penny stock newsletters. If you get one of these penny stock newsletter, better read the fine print on its website. The opposite of the pump and dump is the short and distort scam, where scammers use short selling to make a profit. Short selling happens when an investor is betting on the falling price of the stock. Scammers then use the shorting strategy by borrowing shares from a broker and immediately selling it in the open market. Once the price falls, the short seller scoops up shares at the lower price. He then pockets the difference in profit once he returns the borrowed shares to the lender. Penny stock scammers short sell a stock by spreading false and damaging company rumors to ensure the stock price falls as a result of it. A reverse merger happens when a private company merges itself with a public company to become publicly traded without the hassle and expense of going through traditional listing methods. This process makes it easy for the private company to falsify its earnings and inflate its stock price. There are some legitimate reverse mergers, so be on the lookout for scams by reviewing the business history of the company and researching for spotty or questionable merger activity. Mining scams trace far back into history thanks to the allure of gold, diamonds, and oil. A recent and infamous mining scam is Bre-X in the mid-1990s. The founder, David Walsh, falsely claimed his company had discovered a massive gold mine in Burma. Due to soaring speculation, the valuation of the company, which is all in pennies stocks, reached $4.4 billion by 1997. Once the company collapsed, most investors lost everything. The guru scam is dependent on the guru gaining followers. Thanks to advertising, he shows himself as a success with matching lakefront mansion and fancy car and offering you a way to acquire the same. He does this by positioning himself as a financial expert, promising to share penny stock trading secrets for a one-time low sum. When faced with this offer, delete that email because there is no one-size-fits-all path to riches. There will also be people claiming to own the next best thing and offering you the opportunity of a lifetime to invest and get rich quickly. Stay away from them. The no net sales fraud. Beware of scammers offering shares of stock claiming there will be a big demand for it with a stipulation that it cannot be resold for a certain length of time. Once the SEC discovers and closes the scam, the investors are left with nothing. Offshore rackets. Penny stock scammers love this scam that takes advantage of companies operating outside the US. Because these companies do not need to register their shares when they sell to US investors. Scammers buy cheap and unregistered foreign company shares which then sell to investors at an inflated price. The massive influx of unregistered shares will cause the stock price of the company to drop. The scammers then make money while US investors get little or nothing. How to avoid scams. Now that you know that the penny stock world is rife with market manipulation and fraud with a scale that can be massive, like the massive $3 billion Canadian Bre-X mining scam in 1997. As an investor, you should know that such abusive practices are not exclusive to penny stocks and micro-cap like the notorious cases of Enron and WorldCom prove. How then can you avoid being scammed by dishonest penny stock promoters and scammers who are out to get your money? Here are some suggestions. Promotion versus research. Scammers hire newsletter writers to write flattering reports about their stock to convince you into investing in dud penny stocks by using tricks like outlandish projection and deliberate distortion. These newsletters or white papers look very similar to legitimate research reports. As a penny stock investor, learn to distinguish between stock promotion and equity research. Make an effort to read the disclosures section at the end of the report. Check on the writer and find out if he is paid by the company to write the report. If this is the case, this is not a research report but an advertisement. Grade the quality of management. Penny stock companies are no different from any company. Check the quality of its management. The OTC Markets Group divides securities into a three-tier marketplace based on the integrity of its operations, its level of disclosure and the investor engagement. OTCQX, the top tier, OTCQB, middle tier, and OTC Pink, bottom tier. You may not find someone like Steve Jobs running a penny stock company, but you can look into its track record, check its roster of executives and directors if they have had any notable successes or failures, or any relevant experience at all. Evaluate the financials. Penny stock companies usually do not furnish in-depth financial information, but if they do, it would not hurt to check their financial statements. Scrutinize the balance sheet to check for any substantial debt or liabilities, outstanding as well as its amount of net cash on hand. Here is a tip: if the income statement shows big growth in revenues, it is a promising sign. Know the quality of disclosure. Is the company transparent? The more disclosure the company provides, the better, as it indicates a great level of corporate transparency. Example: the OTC Markets Group divides its securities into a three-tier marketplace: OTCQX, the top tier, OTCQB, middle tier, and OTC Pink, bottom tier. These categories were based on the integrity of the company operations, its level of disclosure, and its investor engagement. OTC Pink company reporting can often be spotty, so OTC Markets Group further segments the grouping, based on the quality and quantity of information provided: current information, limited information, and no information. Warning signs: avoid investing in a company with limited or no information. There are stocks for which OTC Markets Group advises investors to exercise additional care and thorough due diligence that will flash a skull and crossbones caveat emptor sign. A penny stock company will earn this symbol for various reasons. It may be under investigation for fraudulent or criminal activity, or the company may be involved in such dubious promotional activities as spam emails. Is the business plan achievable? Learn to evaluate the business plan of a company if it is achievable and has the asset base it claims to have. Remember the infamous case of Bre-X, mentioned before. It was a Canadian exploration company that claimed to have found one of the biggest gold mines in the world at Busong, Indonesia, which turned out to be a colossal fraud. Bre-X shares climbed from 12 cents to $280 Canadian before the discovery that it was fraudulent. And its collapse in 1997 wiped out $3 billion Canadian in market value. How to buy penny stocks. Once you have an idea of the various scams and how to avoid them, learn these 5 steps to follow when purchasing a penny stock. Evaluate whether the stock has upside potential. You are investing because you like to get a return, right? So ask yourself if the penny stock you are considering has an upside potential, or is it more of a flavor of the day stock, trying to ride the coattails of the latest investment fad. 4 rules to follow. Devise a realistic risk-reward assessment for the stock even if you are only investing a small amount of money. Limit your holdings and diversify. Protect yourself even if you are excited about prospects for your preferred penny stock. Learn to cap your losses by limiting your stock holdings to no more than 1 to 2% of your overall portfolio. Diversify your penny stock portfolio, and it should not exceed 5% to 10% of your overall portfolio, depending on your risk appetite. Check liquidity and trading volumes. Having made a successful investment in a penny stock is great, and you will want to sell your shares eventually. Have adequate liquidity and trading volumes on the stock so you can trade it efficiently. Otherwise, you will end up with a wide bid-ask spread, making it difficult to convert your paper profit into an actual one. Know when to sell. A penny stock is not a long-term buy and hold investment. If you achieve a sizable gain over a short period, book it now and do not wait for a high yield that may not happen. Search for high-quality stocks. There are good prospects and fallen angels. A good prospect include ventures that are set up by experienced managers who came from a previous company and stocks with promising outcomes in biotechnology or natural resources. Fallen angels are the once great companies that ran into trouble but still have comeback potential. Many of the leading technology stocks today were trading in the low single digits at the end of the 2000 to 2002 tech wreck, including some household names like Citigroup Inc. C and La-Z-Boy Inc. LZB that traded below $1 in March 2009. Penny stock trading is risky. It can also be rewarding. Use the things you learn to make an entry into penny stock trading. Good luck.